a mild recession or moderate recession throughout the course of this year, and we see it in the numbers this morning. That should give pause to the Fed interest rate hiking cycle after the next couple of meetings. And so I do think that we'll likely see 50 basis points more of rate hikes, and that should be the end, absent a significant spike in inflation.
And again, 10-year now yielding 3.37%. Among retailers, mixed bag today. Macy's, for example, up 1.3%. Walmart down 2.6%. Target down 0.5%. Kohl's Corp lower now by higher by 0.3%. And Amazon.com down 0.3%. Recapping stocks lower, S&P down 1.5%. And that's a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really appreciate it. Bloomberg Business Week is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. Your small to medium-sized business could be missing out on an opportunity to claim the Employee Retention Credit. Innovation Refunds has helped thousands of small and medium-sized businesses claim over $2 billion in ERC refunds and may be able to help yours too. Learn more at getrefunds.com.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
TikTok, everybody. 17 minutes left in today's trading session. It's been an interesting day, certainly on the equity front. Charlie, of course, breaking down the markets. But really, I think the story largely, and we've talked about this, is the disappointing economic news, Tim, and certainly the pressure that we've seen when it comes to rates. I mean, 10-year, 337 right now, 2-year note with a yield of 408. So we've really seen a move down when it comes to the rate picture.
Yeah, and it was kind of green until we saw that economic data hit at 10 a.m.
equities,
Carol.
right?
Yeah, that's right.
All right, so let's talk about it. Let's get to the drive to the close. Brian Frank is back with us, CIO at Frank Capital Partners, here in our Bloomberg Interactive Broker studio. The Frank Value Fund up nearly 8% in the past month, putting it in the 91st percentile. According to our data, in the past 1 year, the fund gained 6.5%, so beating just about all of its peers. For the past 5 years, the fund has returned on average annually about 5%, again, according to our data. As you know, it's not been easy being a value guy, has it?
No, it's never easy, but the last 5 years were like fire and brimstone. It was a real test.
Happy New Year, Happy New Year. Is it going to be a happy year for value?
I think
We just
so,
talked to
Carol.
Howard Marks talking about sea changes in the investment environment. Don't happen often, but he's saying this low rate environment, people loading up on leverage, could potentially mean opportunities for him in the distressed area. What does it mean for value?
Yeah, certainly. I mean, to hear someone of Howard Marks' caliber say that, because that's what we've been thinking in the value shop as well. Like you said, it's been a miserable environment for value investors over the last few years, but in the early 2000s, 2001, 2002, it was the golden age. And that's what it feels like today, another golden age of value. You have rates going up, you have the growth companies suffering, and you have phenomenal value companies available not only at good valuations, but many of them, at least in our fund, are less cyclical as well, because it looks like there's some pretty bad economic data on the horizon.
So if this is indeed, and we talked to Howard Marks earlier about a quote-unquote sea change, if that is indeed happening, do you see the era of value continuing? I mean, is this a long-term bet, given that interest rates could be high for quite a while?
I think so, and even without those interest rates, I mean, the bond market clearly disagrees with the Fed right now, but in either direction, you're going to have trouble for growth companies. You're seeing layoffs at Microsoft today. I think Google and Facebook are actually cyclical advertising companies instead of technology companies, and the market needs to figure that out and completely revalue those companies for what's ahead. But on the other side of the coin, energy, one of the best performers last year, is actually priced for recession. These companies are still very cheap, but they have much better balance sheets than in the past. I believe energy as a sector is going to have net cash pretty soon, if not already. And there's still a supply issue out there, even if we get demand destruction. So yes, I think the golden age of value is here and can continue.
What kind of positioning or repositioning have you been doing, if at all, Brian, in your portfolio?
We've slowly been selling some of those energy companies that have become fully valued, but we're still very overweight energy. Our best performer last year was H&R Block, which certainly is not an exciting
We've
company.
talked to their CEO several times.
Yeah, and we love what he's done with the place.
Yeah, they've been shifting, right, to much more be kind of a hub for individuals. And we're talking about not necessarily the high end, right? I feel like everybody goes back up to after wealth management, but kind of everyday people, right?
Yeah.
And the services that they need.
That's right. There's some meat in the middle there, and that's what H&R Block is going after. But it was a tremendous value about a year and a half ago. We're up about 150% on it, but we did actually take the gain last year not because of strategy or anything like that, which we totally agree with. It just became fully valued. And with a 4% risk-free rate now, there's a pretty high hurdle to investing in any kind of risk, in my opinion. So you have to choose your spots.
Well, so fixed income versus equity. Like, are you more inclined to play in that fixed income space because the yield not so shabby now?
We also do private wealth management, and we've definitely taken clients much towards the fixed income side as rates have come up. We've still kept duration short, because there are still some pretty smart people out there saying that listen to the Fed and don't listen to the bond market. Maybe inflation will surprise on the upside. And with the value fund, we're about 80% invested, which is our maximum amount of cash.
Largely equity, though, right?
Largely equity, yeah. That one has to be equities. That's typically 100% invested in equities, but we can hold some cash if there aren't opportunities there, and that cash is making 4%, which is great.
So where are you seeing opportunities on the equity side now?
We recently have gotten into the restaurant business. I can't talk about a specific name there, but generally with restaurants, inflation really bit hard, and they weren't able to raise their prices fast enough to cover those costs. But I think if you get some good operators there and some great brand names, they'll eventually catch up and those margins will come back. We're actually worried about margins as a whole for equities, especially going into a recession, but we think maybe the restaurant business can kind of buck that trend.
Tell us about your number one holding.
Our number one holding is something called Calumet Specialty Products, which you probably won't find in any other mutual fund. This is around a $2 billion company that essentially runs a refinery out of Montana, and they're converting their refinery to renewable diesel, and then after that, they're going to convert it to sustainable aviation fuel. So those types of green energy investments typically command a big multiple, because the majors want to buy them for the tax write-offs and for the carbon write-offs. And nobody's recognizing Calumet, probably because it's a limited partnership. Their actual core business is industrial lubricants, which isn't exactly exciting to talk about.
But necessary, right?
It's certainly. And again, we're not making more of this stuff. We're not making more refineries. Calumet, as small as it is set up to be the biggest producer of sustainable aviation fuel over the next few years in the U.S. So it's a nice, interesting little market. And the valuation's pretty cheap on this thing. We love it.
We're out of time. Darn it. Come back soon, will you?
Thank you very much for having me.
Really appreciate it. Brian Frank, he's Chief Investment Officer at Frank Capital Partners. As we mentioned, that Frank Value Fund has been beating just about all of its peers in the past year, up about 6.5% in a year that we know, Tim, not many things were showing positive returns.
Yeah, S&P was down 20% last year, and change. Now it's down 1.5%, the Dow down 1.8%, the NASDAQ 1.1%.
All right, folks, watching the market. Shortly, we'll catch up with our TV colleagues, talk about the market trade, and bring you down to that closing bell. This is Bloomberg.
It is 3:53 on Wall Street. I'm Charlie Pellet with today's company headlines. Job cuts at Microsoft and Amazon, two of the world's biggest companies. They began slashing a total of 28,000 jobs in a post-pandemic reckoning that has left almost no tech name unscathed. Right now, we've got Microsoft down 1.7%. Amazon shares, they are lower now by 0.3%. Bank of America has started telling its executives to pause hiring, except for the most vital positions, as it tries to keep a lid on costs and prepare for a possible economic downturn. Sources say the move is an escalation of the company's decision late last year to slow hiring after few employees decided to leave of their own accord. Bank of America shares down now by 2.5%. Citigroup raising compensation for its junior investment bankers by as much as 15%, even as many Wall Street peers are cutting jobs and slashing bonuses after last year's industry-wide deal slump. Citigroup shares down now by 1.7%. And Credit Suisse Group says it will pay its senior bankers an upfront cash award again this year as executives attempt to incentivize staff to stick with the troubled lender as it undergoes a broad restructuring. ADRs of Credit Suisse, they're down now by just about 1%. A down day for stocks. Those are some of the company stories that we're following this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
All right, everybody, we've just got about 4.5 minutes or so left of today's trading session. We're going to soon catch up with our TV colleagues, talk about the trade today. In the meantime, I feel like we continue to track stories that what they are doing when it comes to hiring, firing. In the case of Citigroup, this is actually some upbeat news.
This is a little crazy to me. I don't want to say crazy. It's a little just surprising.
What?
That they're boosting pay for their most junior employees despite a tough year. Citigroup raising comp for its junior investment bankers by as much as 15%, even as many Wall Street peers are cutting jobs and slashing bonuses after last year's industry-wide deal slump. So what this is telling me, it's still hard to find talent out there.
Correct.
They want to be known as a place that pays.
Correct.
And I don't know, even as layoffs loom in the industry, companies are still hiring.
Yeah, it is interesting, right? This is the push and pull that we kind of get throughout, I feel like, the world at large, right?
But this is kind of like,
What?
wait, what?
Wait, what?
You know?
Bonuses?
Layoffs are happening, bonuses are lower, but we're raising pay 15%?
Yeah, and this again is according to people familiar with the matter. They asked not to be identified discussing internal information, but the pay coming after Citigroup warned investors that inflation would push compensation expenses higher this year. Remember, compensation, right? That was a big thing for Goldman.
Yeah.
The Wall Street giant Citigroup we're talking about, and its rivals are contending also with private equity firms poaching talent, with deal making expected to pick up after a tough year. I remember a good friend of mine, her husband getting an MBA, doing really well, went to Wall Street, but he was constantly thinking about, yeah, but I'm going to end up in Silicon Valley. Like, so this is what's happening in the financial industry. It's not just about getting a job on Wall Street and staying there, you know, running out your career there and your professional life there, but it's about, wait, I could also go to VC firm, I could do private equity, I could do a lot of things.
I have another story that I want to talk about because these are three stories.
Once upon a time.
Yeah,
Yes.
once upon a time, Credit Suisse was going to pay upfront cash bonuses to senior staff.
Yeah.
And it's going to still do that. It's going to pay senior bankers an upfront cash award again this year as executives attempt to incentivize staff to stick with the troubled lender as it undergoes a broad restructuring. This story is different than the other stories we talk about because the problems Credit Suisse is facing are unique to Credit Suisse.
Yeah, it's interesting because remember, the Swiss lender is set to post another annual loss for 2022, so it's an interesting story. A lot when it comes to banker bonuses, some of our conversations out of Davos, so check them out on the Bloomberg terminal. Right now, we're back to the markets, catching up with our TV colleagues because Beyond the Bell on Bloomberg starts right now.
And beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are about 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with Carol Masser, Tim Stenovic, and a welcome to our audiences across Bloomberg Television, Radio, Quick Take, as well as on YouTube. Looking at a market right now that actually, if you can believe it, Carol, started the day higher. But I think once everyone added up all that economic data, we are at the lows of the day, setting up for the worst day that we've had going back to December 15th.
Yeah, very different tone than we've seen so far here in 2023, at least on the equity side of things. But I think you said it correctly before, Romaine. It's really, if you look at the Treasury trade, really significant in terms of what we've seen. Those yields really back off. We got a rate reset, Tim, today, thanks to some of that weaker than expected economic data and inflation data coming down.
Yeah, and it's probably one of the reasons why Brian Frank expressed concern about what equities look like this year. We just spoke to him, he's CIO at Frank Capital Partners. He said that given, the risk-free rate is at 4% right now, equities are a tougher sell. And he repeated something that we've heard from Gina Martin Adams and the Bloomberg intelligence team, is the concern over margins, something that investors are certainly going to be paying close attention to as earnings season continues to unfold.
Yeah, that is the one thing that we come back to time and again for this earnings season, that narrative about margins. And I mentioned this earlier, but you do wonder to what extent the big companies can absorb the decline, the higher input prices, the higher wages, whereas the small companies are really not in a position to pass that on and therefore need to take that as a blow. And you're going to see that affecting their numbers, their financials.
All right, we get the closing bells here in New York, and we got to start off with the S&P 500, which, of course, another failed test of that 200-day moving average. Remember, about a year ago, back in March, we had a meaningful push above it, and that couldn't hold for more than a few days. We had a retest back in August, and then we had, of course, another retest back in late November, early December. None of those held, and now the retest here in January failing once again. 39.28 and change on the S&P 500, down 62 points, or 1.5%. The Dow Jones Industrial Average down 600 points, or 1.8%. The NASDAQ Composite down 138 points, or 1.2%, Carol. And the Russell 2000 is going to finish the day lower by roughly 1.6%.
Yeah, definitely a risk-off trade. If you take a look at the S&P 500, you've got 450 names to the downside, 53 actually gaining some ground. Take a look at the NASDAQ 100, Scarlett, and you've got 90 names to the downside, 11 higher. So investors really not wishing to participate in a big way at all in the equity market today.
Yeah, another way of showing that retreat, how wide it is, how broad it is to look at the S&P 500's 24 industry groups. And it's notable that the best performers are tech, hardware, and equipment, and that's down 0.8%. On the downside, you've got consumer staples, whether it's food, beverage, and tobacco, or food and staples, off by more than 2%. These were some of the best performers of 2022. The banks, of course, wrapping up their earnings season, they're big losers as well, off by 2.7%. And of course, I bring up media once again and tech because Netflix will be kicking things off tomorrow after the close for that sector.
All right, good to know. We'll be watching that one. Right now, I'm watching some of the gainers. There were a few, folks. Romaine, you mentioned this earlier. I love this. The trucking industry tells us so much about what's potentially going on in the economy. J.B. Hunt finishing up with about a 5% gain in today's session. It was #1 gainer in the S&P 500. I love what Citi said, characterized as a better than feared quarter in terms of the earnings. This news, though, lifted trucking stocks overall today, so that was definitely a standout. Moderna, we talked about it late yesterday. This one finishing with a gain of about 3.3%. Keep in mind, it was up almost 9% at its highs today. It was top in the S&P 500 and NASDAQ 100. That news last night, Moderna's vaccine against RSV, highly effective in preventing the disease, the lung disease in older people, paving the way for the company to seek its first approval outside COVID-19. So this is showing Moderna has more legs beyond that COVID vaccine. Qualcomm also top in the S&P 500 and NASDAQ 100 today, up about 1.5%. Company maintaining its quarterly dividend of 75 cents a share. And this is despite Citi initiating a negative catalyst watch, not only on Qualcomm, also on Intel. And their call was given that he expects the analysts there weakness for both stocks during earnings. He did keep his neutral rating on both, but kind of interesting, but Qualcomm kind of bucked even some of that negative tone here, Tim.
Yeah, it was a tough day for you to find gainers. Pretty easy day for me to find decliners. Looking at the bottom of the S&P 500 on a points basis, Microsoft, the worst performer, down 1.9% today. The company did say that it will cut 10,000 jobs this year. That's about 5% of its workforce. A $1.2 billion charge in the fiscal second quarter. Satya Nadella, the company's CEO, saying in a blog post and internal email to employees that the company will continue to hire, in quote, key strategic areas. Scarlett, you mentioned consumer staples, the worst performing sector in the S&P 500 today. Kraft Heinz, the worst performing stock today. It actually closed down 6.3%, down the most since May 26. We did see consumer stocks, staple stocks outperform the S&P in 2022, as you mentioned, but every stock in that group today taking a big hit as concerns over retail sales hit the sector. And then United Airlines down 4.6% today. This despite the company's positive earnings report yesterday. Strong earnings report boosting the airline and carrier peers. Operators' guidance for the first quarter in 23 beat analyst estimates, and brokers pointed to strong results for the guidance for the year. It looked pretty good.
Yeah, let's take a look at the yield space here, because right now we're right around 4% right now on a 2-year yield. That's down about 13 basis points from where we were a day ago. It's even worse there when you get deeper into the curve, 19 basis points or so on a 5-year. And I think you're looking at roughly about 17, 18 basis points on a 10-year. And of course, this is a big rally that we saw in treasuries. They even started before the economic data, guys. This actually started, of course, coming out of the Bank of Japan decision. That was a global rally in sovereign yields and sovereign debt, excuse me. And then, of course, that accelerated once you got the U.S. economic data here. This will be interesting to see, guys, whether this continues over the next few days, particularly as we get more economic data. And then, of course, eventually, at some point, we're going to get a Fed meeting, I think, in about 2 weeks.
On the 31st, and of course, the decision comes out on the 1st. Also, that rally into bonds, we saw plenty of demand for the 20-year auction today as well. So you wonder to what extent how much this is drawing money away from equities. I loved a comment that I read earlier today, guys. It was a question about what's the difference between last year's bear market and this year's bear market. Last year's bear market was driven by interest rates. This one is going to be driven by earnings and perhaps the slowdown, perhaps the shrinking profit margins.
Well, we're awaiting earnings today out of Alcoa, as well as Discover, as well as a few other minor ones as well, guys. I mean, we've already gotten, I think, some decent commentary out of the banks and their read on economic conditions. It'll be interesting to see what these other companies have to say.
Well, this is what's interesting. You know, here we are finally seeing some diversion between what happens with stocks and bonds, right? Stocks go down, bonds go up, yields go down. And, you know, this is once again where investors have to figure out, do we believe the bond market? I feel like they're actually working in tandem at this point, that they're both kind of telling a story about concerns. As you said, you know, Scarlett, what causes the problems? Is it concerns about corporate profits? And maybe that's why we're seeing it in the equity trade. And then what we're seeing in the bond market is concerns about that economic, you know, downturn that ultimately could be a recession here in the United States.
I think we could also read into the economic data that we got today in sort of with a silver lining, the idea that what the Fed has been doing when it comes to raising interest rates and getting inflation under control is actually starting to take effect, and we're starting to see that in the economy. And yes, there are concerns about growth, but you know, that's part of what happens when, you know, they tamp down to get inflation under control. They tamp down the idea of growth, right?
Can I just throw this out there, though? Do you think that all of this is really just because of what the Fed did? I mean, there's going to be a big argument, a big debate, I think, in hindsight, that some of the drawdown that we've been seeing in inflation had to do with some of the more, I guess, structural and transitory issues that the Fed had originally said was basically the whole reason why we saw inflation go up.
I think you're right there, and I also think we have to throw in oil into this and the decline that we've seen in oil, and I think that's also a sort of a key risk moving forward, because that's certainly out of the Fed's control. They can, you know, dampen down demand, but if oil prices go up and whatever happens with Russia's invasion of Ukraine continuing, that's certainly a risk out there.
And also demographics, which is you have an aging society in a lot of the developed world. In the U.S., the labor pool is different from what it was before the pandemic, and immigration has been a real big source of labor in the U.S. that is no longer the case now in 2022.
No, I want to go back to what you said, Romaine. Like, I agree with that. Like, we knew what were the problems during the pandemic and why supply chains, you know, were so snarled, right? And so are we back to somewhat more normal, right, the way it should be? And then you layer on top of that kind of what the Fed's doing, and maybe that's why we're kind of getting things exaggerated a bit.
But does that explain inflation in the services area? I don't think it does.
It doesn't, and I mean, I think the problem right now is that the Fed, I don't think even knows, right? You know, I mean, they obviously know more than we do, but at the end of the day, I think they're flying blind, just like everybody else. And when you consider just how much the lag is, the question is, when do you get to a point where you feel comfortable pausing and assessing?
All right, don't make me mention 1980 all over again, as I did earlier, because that whenever you say pause, or I kind of think back to what Mike McKee told us earlier. So history has a tendency to repeat itself, of course.
It's not an exact science. We know that.
I was
right?
cleaning out a storage unit the other day, and I had like all these cassette tapes that I bought when I was a kid.
Speaking of 1980.
So maybe maybe the 80s are back. I have nothing to play them on, but
I hope you saved those.
They're there.
Are you going to be on an episode of Storage Wars? That's all I want.
Possibly.
That would be exciting. All right.
Hoarders.
All right. That's a wrap, guys. We got to run. That is our simulcast on radio, TV, YouTube, and Bloomberg Quick Take. We call it Beyond the Bell. We will see you again. Same time, same place. Latest data point, it sounds like investors maybe were saying, I don't want to spend money, or maybe I don't have it to spend.
Yeah, okay, so let's talk about this from the perspective of the data that we got earlier, Carol. Retail sales, once again, it's worth repeating because it really moved the market. Fell by the most in a year, and business equipment production slumped, raising concerns that the economy is losing momentum under the weight of tighter Federal Reserve policy. We saw what happened to equities and fixed income today as a result. The value of overall retail purchases broadly decreasing at 1.1% in December after a downwardly revised 1% drop the prior month. That's according to Commerce Department data that we got this morning.
So what we want to know is, how is this all playing out when it comes to commercial real estate, especially with the retail sector? Angie Solanki is the National Director of U.S. Retail at the global real estate services firm Colliers. She's with us via Zoom in San Francisco. Angie, it's so nice to have you here with us. We did get that data today, retail sales in the U.S., a disappointment. What signs are you seeing when it comes to the real estate space that kind of support that economic data point?
So just a little bit of clarity. So when we say 1.1, it includes autos. So if we take that out, it's actually 0.7%. But that's month over month, and that's November to December. But if we look at year-to-date 2022, it was actually pretty healthy in the core retail sector, where it was roughly around 6.8%. So we still see some resiliency as it relates to retail. From a commercial real estate point of view, I would say that in speaking with our colleagues across the U.S., which we have more, over 500, we're still seeing strong leasing velocity as it relates to the leasing aspect. So good growth from a leasing point of view, a little bit of a slowdown when it comes to the investment sales side. Still healthy, but still somewhat cautious because there's great demand, but not a lot of supply.
And let me just counter. I mean, ex-auto and gas, it was down 0.7%, expected to be just down, or actually flat. And the prior read was down 0.2%. That was revised down to 0.5%. So it's, to be fair, it's a different type of trend line or data point than we've seen in some time. And that's why everybody's kind of sitting up and taking notice.
Definitely. But I think what helps also is that if we stop and look at the slowing down of CPI, which we're seeing a little bit of that as was discussed. I think that, coupled with, if we can maintain these low gas prices, the job market continues to be healthy. We're still seeing a very cautious but yet mindful spend in consumer spend. At the moment right now, we're seeing a roughly in the grocery sector, by example, roughly $90 per person per week spend. Some of that is related to inflation, but nonetheless, there is still that continued spend in the grocery and food sector.
So as you look across the portfolio,
because we have to eat.
Yeah.
To be fair. Sorry.
Yeah, and some more than others, like me, as you know, anytime you travel with me, Carol.
I do know.
So I guess the question I have is about regional differences, and also what you're seeing in terms of the types of companies that are coming in to sign these long-term leases, because we've certainly seen a shift in what space is used for. So what are some generalizations you can give us?
Yeah, definitely. We're starting to see more non-traditional retail come to play. So, for example, we're seeing this continuation of within the healthcare sector, some med retail, as we call it. We're also seeing more in the wellness, specialized wellness, educational, pet sector. So these are definitely areas where, by putting these types of uses within shopping centers that have grocery drug anchored, it really definitely amplifies, as we know.
I just want to jump in. When you say med stuff, I'm curious. I see, this is anecdotal, but I see like these not COVID testing centers, but they're more like walk-in urgent cares popping up everywhere in New York City.
And I'm using them everywhere.
Yeah, I am. Went to one yesterday. And is that when you talk about medical tenants, is that who you're talking about? Are you talking about dentists? What are you talking about?
Yeah, no, you hit the nail on the head. It's definitely more that, call it urgent care, but more preferred care. So very specialized. When you go into these, call it clinics, they're much more curated in terms of how they look and feel. So it's not so traditional in that kind of stale hospital, atmosphere. So we're starting to see that take shift. We're also seeing retailers that are 3,000 square feet or below. There's a handful of retailers in that space, and many that are coming into the U.S. from other countries.
So I'm curious, we just talked to Howard Marks of Oaktree, well-known distressed investor, and he made a really good case that, we've all been spoiled by this low-rate environment, very easy money environment. And then also as asset prices have risen over the last 10 years or so, coming off the great financial crisis, it has created in many ways also an environment where there's a lot of leverage out there. I am curious if you are seeing some leverage areas within the real estate and retail market, or some distress situations where there's some growing momentum, the numbers are growing.
So there was actually a conference that occurred just last week, and I was chatting with a lot of our investment sales folks, and what they shared back was that the institutional climate and the REIT climate still seems to be very positive as it relates to retail. So retail, multi-tenant, grocery anchored, because again, as I just reported, sales in the grocery sector are still healthy and strong. And then the other side of it is on the single net building. So there's still, when you look at cap rates, although they're softening slightly, they're still a great investment. That we're seeing, and it's again market by market, but still the 1031 exchange in the single tenant space is still quite active. So we're being cautious. We're monitoring. I think at the end of 2022 there was a little concern if we're going to see the CMBS side of things kind of really increase on the regional multi-tenant side. But as of just a week ago, people are still quite positive as it relates to that.
But you do say retail investors are hoarding cash, correct?
They are hoarding. They're really spending or buying, I should say, as it relates to the type of retail, the anchor tenants, the longevity and the stability of those tenants and uses. So brands, as I mentioned, from a grocery perspective, where you're seeing strong grocery sales and foot traffic, that foot traffic correlates with cross-shopping to other retailers. So if that shopping center that is grocery anchored has seen stabilized sales and is even moving back to pre-pandemic or higher than pre-pandemic, those are going to be in high demand.
All right, we're going to leave it on that note. Angie, thank you so much. Angie Solanki, she is National Director of U.S. Retailer at Colliers, the global real estate services firm, joining us via Zoom in San Francisco. We are in earnings season. It's early going, but there's a name that we wanted to bring to you because we're seeing the stock move in the after hours. In fact, it's down about 4%. Tim, we're talking about Alcoa, so we're talking about, the commodity space, metals. Alcoa fourth quarter adjusted EBITDA, $29 million. That looks like a huge miss. The estimate was for $106.9 million. If you look at fourth quarter sales, pretty much in line, $2.66 billion versus $2.60. Adjusted loss, we're talking about 70 cents a share. The estimated loss was for 71 cents a share.
Yeah, some interesting commentary as I look through the press release. Alcoa is saying that the company, quote, worked to mitigate challenging market conditions throughout the year that included high costs for raw materials and energy and lower sequential pricing in the alumina and aluminum segments in the fourth quarter.
Our Joe Doe, who covers this space so well, putting out a quick story for us. Alcoa's aluminum shipments will be weaker than anticipated this year amid ongoing uncertainties caused by global inflation, dwindling demand in Europe, and a soft economic outlook in China, which is, as you know, the world's biggest consumer. So, this is why we talk about the China story a lot. They've done a 180, COVID zero, opening up. but it's not going to be a straight path up when it comes to growth, and so lots of questions still out there.
Yeah, Roy Harvey, the company's president and CEO, calling out that in the press release, saying, quote, last year, global turbulence negatively influenced costs for energy and raw materials, and we saw significant variance on product pricing between the first and second halves of 2022.
Aluminum prices dropping more than 15% last year as demand for autos, appliances, and window frames dwindled in the face of surging global inflation and a slowdown in consumer consumption. Shares of Alcoa in the aftermarket, they are down 4.6%. This is Bloomberg.
headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. I'm Charlie Pellet. Lots of earnings after the bell. We begin with Alcoa. Its aluminum shipments will be weaker than anticipated this year amid ongoing uncertainties caused by global inflation, dwindling demand in Europe, and a soft economic outlook in China, the world's biggest consumer. Right now, we have got Alcoa shares down after a big miss on profit. Alcoa down now by 3.6%. Discover Financial reported earnings per share for the the fourth quarter that beat the average analyst estimate. Discover up now by just about 0.4%. The stock mood turned ugly on Wall Street today as slowdown fears resurfaced. S&P dropped 62 points, closing at session lows, down 1.6%. The Dow down 613, a decline there of 1.8%. Nasdaq down 138, a drop there of 1.2%. 10-year yield 3.36%. The 2-year 4.07%. Spot gold 19.04 the ounce, down 0.2%. Bitcoin today was down 2.6%, 20,767 on Bitcoin, and West Texas Intermediate crude down 1.1%, 79.27 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really do appreciate it. Bloomberg Business Week is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. In about 8 minutes, you can find out if your business qualifies for Employment Retention Credit Assistance. Innovation Refunds has helped thousands of small to medium-sized businesses claim the ERC and may be able to help yours too. Time is running out to claim the ERC, so get started today. Learn more at getrefunds.com.
All right, Tim. Well, our next guest has worked in both the private and public sectors. He's held senior executive positions at Microsoft, former CEO worldwide of Burson Marsteller Advertising, a former senior strategy advisor to both Hillary and Bill Clinton. He's also reportedly counseled former President Donald Trump. Today, he is chairman and CEO at the $2 billion publicly held advertising and marketing firm Stagwell, and we are delighted to have with us Mark Penn. He joins us via Zoom from Miami, Florida. Mark, how are you?
Good. Thank you very much.
Well, it's good to have you here with us. We want to talk a little bit about brands. It's an interesting time, especially in the advertising space, because we are kind of rethinking the social media advertising space. It does feel like it's going through a gut check. How do you see the environment going forward?
Well, of course, there's a lot of uncertainty in the overall market and in the economy as we saw today. But advertising itself has held up reasonably well. I think that we see the digital advertising marketplace as still a growing marketplace, despite the economic conditions. I always say that we're the part of the economy the Fed keeps trying to slow down, and so consequently, we're not, seeing, I think, the kind of slowdown that you would see immediately in the housing market or the mortgage market, where you see such price increases. That's not to say that the clients aren't cautious and kind of waiting to see their budgets. And I also think there's a lot more competition, out there among Facebook and Google and the other big advertising players. But that's good for advertisers.
So, what are they waiting for? What are they waiting for to happen? I mean, what will be a catalyst to say, okay, we're okay spending money here. We're okay investing in this. Because we hear that a lot, that there's like this lack of clarity, whether you're talking financial markets, whether you're talking the economy. What are your clients waiting for?
Well, look, I think everyone is waiting for the Fed to declare that it's done its mission of bringing down inflation enough, and so isn't trying to slow the economy down. I mean, it's very hard to, project out a strong economy if somebody's got their foot on the brake, right? And they keep tightening their foot on the brake. And so quite obviously, I think people have legitimate concerns. Having said that, we just went through the holiday season. I think everyone thought it was a reasonably good holiday season. And remember, a lot of marketing happens at the end of next year. So a lot of companies can kind of slow roll it during some of this season and wait really until the summer to see how they project the holiday season, because that's when, let's say 60% of marketing expenditures really occur.
We talked with Richard Edelman of Edelman. They put out their trust barometer regularly. And, in terms of where do consumers, individuals, who do they trust? Is it government? Is it business? And, it is interesting that business, came out as the only trusted institution versus NGOs versus government versus media. I mean, that was pretty interesting coming off of, and maybe it's because we're coming off the pandemic where we felt like a lot of companies, Tim, actually really helped their workers.
But I think it's also like, Richard Edelman talked about yesterday, it's polarization within media that we see. And it's not just here in the U.S. I mean, look what happened in Brazil just a couple of weeks ago as well. Mark, I'm wondering if that's a trend that you're seeing as well.
Well, frankly, we've seen that trend for a couple of years. We have the Harris poll, and the Harris poll reputation quotient identified that, coming out of the pandemic. So I'm surprised that Richard finally got with it. I think he's been showing negative trust with business for so long, which I always thought was incorrect, right? I always thought that it was a misleading kind of index about trust. The truth of the matter is that people trusted business during the pandemic because grocery stores kept operating, Amazon delivered, Federal Express delivered, the healthcare companies found vaccines. I think people's trust in business, which I always thought was much stronger than reported, was affirmed during the pandemic because it was really business more than government. They feel that got them through that.
But do you see that as problematic? It's like a lack of trust in institutions. I mean, we saw it play out on January 6th.
Well, look, is it a lack of trust in institutions, or is it really a polarization? You see, when you have, and I think this is really more of what the problem is relative to government institutions. The military, for example, has a very high rating, close to 80%. The police are actually at about 70%, despite the controversy about them. But the FBI and the Justice Department are only around 50 because, and this is true of corporations, if you're seen as doing a broad public service to everyone, you can achieve a high rating. When I worked with President Clinton at the end of the presidency, we got up into the job rating over the 70s, right? And Ronald Reagan also had job ratings that high. But the minute that you're seen as partisan, then you can't get above 50 because you have one group that's going to like you and another group that's going to not like you. And more institutions, I think, and more media have chosen the partisan route rather than the old Walter Cronkite kind of route, right?
You say these job approval numbers, and they're like, alien to me because throughout this presidency and the last presidency, we haven't seen anything close to those numbers. Is it possible?
Well, because neither of them kept their promise to unify the country. And I think when the pandemic came along, both presidents, rather than appoint a bipartisan group and a bipartisan commission to look at what was going on, maybe have a general head it, they instead inserted themselves, only picked people from their own party. It was considered exceptional when they visited a Republican state. And that's really not how I think President Clinton would have done it, who I worked with for many years. We would have been very careful to say this is a national problem. We are going to tackle this together. We're going to bring Democrats and Republicans together. We're going to everybody on board, and not let this try to be a Democratic accomplishment or a Republican accomplishment. I think the last two presidents made that mistake, and I think it was an unfortunate one.
How much you're, working with companies, marketing, advertising, how much do brands spend on repairing their trust or building their trust with their consumer?
Well, I mean, everything that a brand does is about trust. When you analyze corporate reputation, what I found over the long term is that there are really two major factors. There's the performance factor. How does a corporation deliver? Do the planes come in on time? Is the product quality high? Does the software work, right? And then there's the citizenship factor. Are they good citizens? Do they contribute to society? Are they honest? Are they trustworthy? Are they responsible? And some companies can be great performers, but lousy citizens. Some can be great citizens, but when you peer under the hood, their product is not so good, right? And so to really get to the pinnacle, you have to be both of those, right? And both of those in a well-coordinated way. Because image is not just something that's made up, or it is the result, and increasingly today, the result of how people experience companies, and more people experience companies through online experiences.
Right. Oh, can you end with giving a couple examples, just in the last 30 seconds we have, of one brand doing really well today and one brand not doing so well?
Well, Amazon is a brand that does incredibly well, right? It made a promise to deliver things in a day or 2 days, and it does. It interacts with people in an efficient way. And it's seen as being a relatively apolitical, good citizen, and during the pandemic really helped people out.
I would argue that many would say with some of its workers that that isn't necessarily the case, and hence some of the unionization. Mark, we've run out of time. We've got to run. Mark Penn, Chairman and CEO at Stagwell, joining us via Zoom from Miami, Florida. He mentioned Amazon. Well, some headlines crossing. Apple to expand its smart home lineup, taking on Amazon and Google, working on a line of smart displays based on the iPad and preparing a faster TV set-top box for the first half of 2024.
All right. Well, let's get a check on the world and national news. For that, we go to Nancy Lyons in our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. Officials in Ukraine are still looking for the cause of today's helicopter crash that killed the country's interior minister and at least 17 others. The helicopter went down near a kindergarten and an apartment building in the suburb of Kyiv. At least 29 were injured. U.S. National Security spokesman John Kirby.
We don't have any notion right now as to what caused that crash to occur. Ukraine is investigating. We certainly aren't going to get ahead of them and their efforts.
Kirby says the fighting in Ukraine has been extremely brutal in the past few days. A Russian who ran a cryptocurrency exchange has been arrested in Miami. We get more on that from Bloomberg's Irv Chapman.
Anatoly Lekodimov, who was based in China, mostly serviced Russian cyber criminals, Deputy Treasury Secretary Wally Adeyemo said at a news conference.
Bislato has repeatedly facilitated transactions for Russian-affiliated ransomware groups, including a group that has links to the Russian government and to Russian-connected darknet markets. It is well known that Russia is a haven of cyber criminals, where the government often enlists them for its own malicious purposes.
The charges followed the creation of a cryptocurrency enforcement team at the Department of Justice. In Washington, Irv Chapman, Bloomberg Radio.
Fed Chair Jay Powell has apparently tested positive for COVID-19 and is experiencing mild symptoms. The Fed says Powell is up to date with all his COVID vaccines and boosters and will work remotely while he recovers. A setback for New York Governor Kathy Hochul. Her pick to head the state's highest court was rejected by a key state Senate committee. Lawmakers were concerned about Hector LaSalle's conservative record. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
It's 4:41 on Wall Street. I'm Charlie Pellet. Apple said to be working on a slate of devices aimed at challenging Amazon and Google in the smart home market, including new displays and a faster TV set-top box after relaunching its larger HomePod speaker. Apple shares after hours down now by 0.6%. Alcoa says its aluminum shipments will be weaker than anticipated this year amid ongoing uncertainties caused by global inflation, dwindling demand in Europe, and a soft economic outlook in China. Right now, we've got Alcoa shares down after a big miss on profit, down by 3.6%. Well, as for the overall market outlook, it was a down day today, big time, and where to find opportunities. Brian Frank is Chief Investment Officer at Frank Capital Partners, and he was our guest right here on Bloomberg Business Week.
It's been a miserable environment for value investors over the last few years, but in the early 2000s, 2001, 2002, it was the golden age. And that's what it feels like today, another golden age of value. You have rates going up, you have the growth companies suffering, and you have phenomenal value companies available not only at good valuations, but many of them, at least in our fund, are less cyclical as well, because it looks like there's some pretty bad economic data on the horizon.
Indeed, today we have the stock mood turned ugly as slowdown fears surfaced. S&P fell 63, a drop of 1.6%. The Dow today dropped 613 points, down 1.8%. Nasdaq was down 138, drop there of 1.2%. 10-year yield 3.37%, with the 2-year yielding 4.08%. Spot gold 19.03 the ounce, down 0.3%. West Texas Intermediate crude down 1.4%, 79.07 a barrel. The email marketing and newsletter service MailChimp said it was hacked and that customer accounts were accessed in the second such attack in less than a year. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, the companies that we talk about each and every day, you know, they begin as ideas, maybe in a garage in Silicon Valley or perhaps in a rented office space in Albuquerque. But from that idea to an actual functioning business can be a rocky road, Tim.
Yeah, you got to beg investors for money. You got to manage a growing workforce. You got to figure out how to scale. And ultimately, if you're lucky, you'll get to a successful exit, whether it's an IPO or an acquisition. But it is a tough slog. If only there were a handbook for entrepreneurs.
There actually are. Next guest says he has written one. Ori Levine, he knows a thing or two about building a company, co-founder of Waze, which, as you know, sold to Google for $1.15 billion back in 2013. He was an investor in Move It, which Intel bought for $1 billion back in 2020, Tim.
He's got a brand new book out. It's called Fall in Love with the Problem, Not the Solution, a handbook for entrepreneurs. He joins us on the phone from New York City. Ori, how are you? Good to have you with us.
Thank you. I'm excellent. And yourself?
We're doing well, thanks. We're very pleased. Congratulations on the book as well, Ori. I'm wondering about starting this idea in terms of thinking about not just this handbook, but about your own journey as an entrepreneur. What does it mean to fall in love with a problem?
So essentially, when you fall in love with the problem remains your North Star of your journey, right? And when you have a North Star, then at the end of the day, you're less likely to do deviations from it and more likely to actually get to your destination. But there is another major part of it, right? Because the story that you're going to tell when it's associated with the problem is way better than the story that is associated with the solution. If we will be here in 2007 and I will tell you that I'm going to build an AI-based crowdsourced navigation system, then you would say, yeah, right, but you don't really care.
Well, what was the problem? What was the problem, though, that you were trying to solve in 2007?
I'm going to help you to avoid traffic jams.
All right, It worked.
And then you do care.
It's pretty, every time, and I am an all-in fan on it. And, I will say my husband's kind of laughs at me because when it's like there's a car on the road, I'm like, I hit it and I, contribute to it. You've gotten the world to buy in and help you in this process. Is there something, though, in society or that you think, though, has changed? We talk so much about the sharing economy, the sharing society. Is there something different that enabled ways to be created that could have been created maybe 20, 30 years ago, beyond the technology component of it?
I think that in general, people are like to help each other, right? And so in general, people are good. And if you create them the opportunity, then they will be happy to share. They will be happy to create value for others. And the magic of Waze is that we, the drivers, are helping the rest of the drivers to avoid traffic jams and to know what's going on the road. And essentially, it's sort of a social network of drivers that we are helping the rest of the drivers.
What's a problem in today's world that needs to be solved?
Besides that, my puppy needs to be trained.
There's an app for that.
I wish.
There's probably an app for that, right? But at the end of the day, there are a lot of problems, right? And because when we think of different issues, and by the way, when we started Waze, traffic jams today are more severe than they were when we started Waze. And we actually were scheduled, our mission was to help drivers to avoid traffic jams, and traffic jams today are even more severe, right? And so we are not done with addressing mobility. And Movit actually did a better job in addressing mobility by making public transportation easier. But we're still not done. And, one of my startups is trying to address parking because it's a major issue. And many of my startups, each one of them is trying to address a different problem.
I am curious how you look at some of the companies that were once startups but are now behemoths in the technology space but are having a tough time. AK Facebook, now Meta, Tesla, Twitter. How do you look at them? Because just because you're a startup and people can be excited and you can do well for a while, it doesn't necessarily mean you have legs. But how do you look at some of these companies as somebody who's created companies and companies with legs?
So let me ask you the following, right? And this is really how fast the world is changing, right? Google and Amazon and Netflix are about 20-something years old, right? And then Tesla and Facebook and Twitter and Airbnb are less than 20 years old. They were amazing entrepreneurs at the beginning that had a mission to change the world. And in their journey, they have made the world a way better place. Right? Just imagine that we will have a time machine, and I will send you back 15 years into 2007 or 2008, right? Just before we started Waze. And that means that I'm going to take away your iPhone and Waze and Uber and Netflix and pretty much everything that you're using every day. It's unclear that we will survive. So when we create a solution to a real problem, it's guaranteed that we are creating value. And when we create value, we are likely to become successful. Now, whether or not we are looking at the valuations that were here in the last couple of years or the valuations today, it doesn't really make the difference in the value that those companies have created and in the goodness that they have created.
There was a saying that companies oftentimes, before the pandemic, you'd see startups get ridiculous funding rounds, and they were in search of a problem to solve. What's one company that you saw or a startup that you saw that you passed funding on because you said, wait a second, this isn't out there solving a problem?
So most of my startups are actually self-made, right? So I was looking at a specific problem and then find the right team, or maybe the team came to me very early phase, right? So way before they even started with a problem that they would like to solve. And I basically say, this is a problem worth solving. And so my recommendation will be, think of a problem that is worth solving, a big problem, something that the world will become a better place if you address that. And then ask yourself, who has this problem? Now, if you happen to be the only person on the planet with this problem, then I would say, you know what, go to a shrink. It's going to be way cheaper and faster than building a startup. But if a lot of people actually have this problem, then what you really want to do next is go and speak with those people and understand their perception of the problem. and only then go and build the solution. Now, if you follow this path and your solution works,
right,
it's actually guaranteed that you are creating value.
Wow.
And the essence of all startups is to figure out what is the value that we are creating.
Got it. Ori, we have to leave it there. Ori Levine, co-founder of Waze, his new book, Fall in Love with the Problem, Not the Solution, a handbook for entrepreneurs, something he knows a lot about. This is Bloomberg.
It is 4:53 on Wall Street. I'm Charlie Pellet with today's company headlines. Apple's working on a slate of devices aimed at challenging Amazon and Google in the smart home market, including new displays and a faster TV set-top box after relaunching its larger HomePod speaker. The push into smart displays will start with a tablet product, essentially a low-end iPad that can control things like thermostats and lights. After hours, we've got Apple down now by about 0.7%. Alcoa out with earnings, stock down 3.5% after hours. Alcoa's aluminum shipments will be weaker than anticipated this year amid ongoing uncertainties caused by global inflation, dwindling demand in Europe, and a soft economic outlook in China, the world's biggest consumer. Also out with earnings after hours, Discover Financial. It reported earnings per share for the fourth quarter that beat the average analyst estimate. Genesis crisis, global capital is laying the groundwork for a bankruptcy filing as soon as this week, this according to sources. The Job Acts being delivered at Amazon and Microsoft, two of the world's biggest companies. They have begun cutting a total of 28,000 jobs today in a post-pandemic reckoning that has left almost no tech name unscathed. Today, shares of Amazon.com dropped by 0.6%, while Microsoft shares today fell $4.54, down by just about 3%. Those are our company stories, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
It's Bloomberg Business Week. Let's get a check on the latest world and national news with Nancy Lyons in the 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. Ukrainian President Volodymyr Zelensky says tragedies are outpacing life and tyranny is outpacing democracy as Russia's war drags on. He spoke today before the World Economic Forum in Davos.
The world will overcome again. The time is high to make it happen faster.
Zelensky says the world must not hesitate to provide help to Ukraine. Well, as the country prepares to hit its debt ceiling tomorrow, White House Press Secretary Karine Jean-Pierre called on Congress, including Republicans opposed to it, to act to raise it.
It is essential for Congress to recognize that dealing with the debt ceiling is their constitutional responsibility. This is an easy one. This is something that should be happening without conditions.
Jean-Pierre says neglecting to raise the debt ceiling risks putting the nation in default, halting government and military funding, and threatening millions of jobs. The husband of a missing Massachusetts woman has been ordered held without bail. Brian Walsh now faces charges of murder in the case of his missing wife, Anna. Prosecutor Lynn Beelan outlined some of the evidence they've collected, including his Google searches.
You search how long before a body starts to smell. At 4:58 a.m., how to stop a body from decomposing.
Beelan says police also have recovered 10 trash bags with blood-stained items, including slippers containing both of their DNA. Moderna says its vaccine against RSV appears to be highly effective in preventing the lung disease in older people. It paves the way for the company to seek its first approval outside of COVID-19. The company's CEO says Moderna may apply for approval using a recently acquired voucher for expedited review that could allow the company to launch its vaccine this year. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. Back to you, Carol and Tim.
You sound tired, Nancy.
Carol, I don't think you do, Nancy.
I feel that. Maybe it's just me.
Well, it is Wednesday, Carol.
Yes.
Bloomberg Business Week is brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. There is still time to claim the Employee Retention Credit. Unlike the PPP, the ERC is not alone. Business owners can use the ERC to expand their company, pay off debts, or hire new talent. The money is there to help your business as you see fit. Learn more at getrefunds.com.
All right, coming up in just a moment, Sound On, Bloomberg Sound On, right here on Bloomberg Radio. The host, of course, Joe Matthew. Joe, what's top of mind today?
First of all, the great political conversations on your program, Mark Pensley. I can't prepare for my own show because I have to hear yours. So cheers to you guys. This is fantastic. We actually have, we're gonna tackle this debt ceiling issue with a bit of a different wrinkle as we seek a solution with the great Maya McGinnis, who joins us from the Committee for a Responsible Federal Budget. What